hemos empezado con Fernando Zunzunegui y ahora vamos a intentar hacerlo desde una perspectiva un poquito más internacional. Vamos a conectar con Octavio Marenzi, CEO de Opimas LLC. Octavio, thank you so much for being here in Negocios Televisión.
Thank you very much.
First of all, I wanted to ask you what happened with Silicon Valley Bank in order to trigger this market panic on a banking system collapse. What happened?
I guess Silicon Valley Bank has been fairly concentrated in one sort of depositor, and that's been largely corporations and startup companies who started to pull their money out of Silicon Valley Bank for the simple reason they could get better returns elsewhere. So not only did the segment that Silicon Valley Bank was serving do badly over the course of the past year, they also were starting to say, well, I can get far greater returns by putting my money in very short-term US treasuries, 6-month treasuries returning 5%. That's much better than leaving the money in the bank and getting zero. So Silicon Valley Bank started to see all these deposits flying out of the bank, and that became faster and faster. And that's just a classic run on the bank. That's what banks have done for a long, long time.
Yeah, basically that's the business of the banking sector, right? The bank's franchise in the UK, in the United Kingdom, has been purchased this morning by HSBC with only $1, something similar to what happened here in Spain with Banco Popular and Banco Santander. But does this mean SVB, Silicon Valley Bank, can survive from now on?
Well, I think SVB Bank is gone. It's finished. It's going to disappear. So, yes, HSBC did buy, for sort of a symbolic £1, bought the entire SVB franchise in the United Kingdom. I suspect behind the scenes, the Bank of England had to guarantee HSBC that they wouldn't make any losses on the transaction, because really HSBC did not have enough time to look at what they were buying. I mean, all this happened over the weekend. I find it hard to believe that HSBC's analysts and their due diligence people and acquisitions had the time to look at it at all. So they're basically, HSBC is buying something without knowing what's in it. So the regulators, I'm sure, had to give them some sort of guarantees, maybe not money up front, but basically assuring them that they will not make any losses on this transaction. Otherwise, they wouldn't have done it. So, no, SVB is gone. I think it's going to be merged into HSBC. I doubt very much they'll continue to use the brand name. And in the US, it's going to be wound up and disappear as well. So, no, the bank is finished and it's gone. We'll never see it again.
Mm-hmm. One of the doubts that right now the stock market has is if there's going to be a contagion in the rest of the banking sector in the world. For example, today we're seeing big banks in Europe like Credit Suisse or the Spanish Sabadell plunging in the stock market. Do you think this will spread to other banks, specifically here in Europe? Because, for example, today we heard some politicians here in Europe, in Spain, in France, in Germany, saying that there is not going to be a spread of this risk to other banks. Do you believe this is going to be like this?
Well, I think overall it's a very difficult time period for banks in Europe and in the US. So what we've seen is an extended period of very, very low interest rates. We saw tremendous volume of deposits pour into the banks during the pandemic. That is starting to recede again now. And so we have a combination of things: deposits coming out of the banks, and deposits coming down, interest rates going up very, very rapidly, but not just in a sort of parallel shift in terms of the yield curve, but shorter term interest rates in particular going up much more quickly than longer term rates. And that's bad for the banking sector. Banking likes to have higher long-term rates and very low short-term rates, and as that equalizes out, that's bad in terms of the net interest margin they'll be able to achieve. Though they've done pretty well so far, but that is catching up with them now. So, no, I don't think anyone is really immune to this. These are stresses that are going to be in the banking industry around the world. But I wouldn't necessarily use the word contagion. That sort of suggests that if we'd stopped it with SVB or saved SVB, then it wouldn't have carried on going. No, it's basically everyone's swimming in the same water and the water is drifting away. It's not a question of one bank really infecting the others. So there's no good way to stop this at this stage. And it looks like the US equities markets are not believing the regulators and the central banks that they have this under control.
How is what happened with Silicon Valley Bank related to interest rate hikes? And if this is like this, if there's any relation between interest rate hikes in Federal Reserve or in Europe as well, what does this tell us about how it can spread to other banks?
Well, I think if you think about the bank's balance sheet, right, on the one hand, they have the liabilities, which are basically the deposits they receive from customers. So customers come and put money into the bank. Then the bank turns around and typically will lend that money out and create assets out of it, loans, or they'll invest in securities. Now, over the course of the past 2 years, so much money has poured into the US banking sector in the form of deposits that they've not been able to lend that out to corporations and companies or to in the form of mortgages. So they've basically gone and bought securities. And they bought mortgage-backed securities and US treasuries and government securities. Pretty safe stuff, but they were very long dated. So once interest rates started to increase, there was sort of a pincer effect on Silicon Valley's bank's balance sheet. First of all, deposits started to be removed because people said, I can get better returns elsewhere. I don't need to leave my money in a checking account at Silicon Valley Bank and get 0%. And then also the money that they had invested into bonds went down because interest rates went up. So as interest rates goes up, the value of bonds comes down, and basically you saw a catastrophe unfold. Deposits going out the door, flying out the door very, very quickly, and accelerating also as depositors saw that Silicon Valley Bank had troubles. So it was sort of a pincer effect. It came at them from both sides. Their assets lost in value because interest rates went up, and they lost their deposit base also because interest rates went up. So that crushed the bank. It was basically just a story of increasing interest rates.
Now, what's really interesting, Octavio, is what the Federal Reserve is going to do next week with a meeting that we have next week on Wednesday. What do you think Jerome Powell could do next week? Do you think it could pause interest rate hikes? Because some people, for example, from Goldman Sachs, they say that they believe that this is going to happen. Jerome Powell is not going to hike interest rates, as he said last week. Do you think this is going to be the case?
I bet you Jerome Powell has no idea what he's going to do right now. So I think the poor man is sitting there very confused, unsure what hit him. I think they had a real scramble over the weekend to find some sort of solution for SVB, but for the banking sector more broadly, because they see these stresses and strains throughout the US banking sector. So they thought they'd come up with a great solution on Sunday evening. They said, okay, this is going to put people to rest. It's going to allay all their fears. We're basically going to backstop the US banking industry. Anyone who comes to us with securities, even if they've lost in value, we will lend them money for the full original purchase amount, and so they'll be able to basically deal with any deposit withdrawals. But it looks like the US equity markets are not listening to him at all. So we've seen a number of US banks lose market share and lose market value tremendously today. Worst of all, First Republic, whose stock price went down over 70, and I think even touched 80% down today. Banks do not survive an 80% decline in their equity. There's no good way to do that. So I think Jerome Powell must be very confused and somewhat dazed and grasping to find solutions. Simply pausing the rate at which he increases the interest rate is not going to be enough. He's going to have to do something much, much more radical than that.
Octavio Marenzi, CEO of Opimas LLC, thank you so much for being here. It's been a pleasure to speak to you here in Negocios Televisión.
Thank you very much.
Bueno, pues nos decía Octavio, entre otras